We're just waiting for everybody to join, but we will be starting very shortly. So just seeing people come in. Great to see so many of you here. Thank you. Still a few people coming in, but I think we can now start. So hello everybody. I'm Louise Pryor and I'm president of the Institute and Faculty of Actuaries. And I'm absolutely delighted to be able to welcome you to the second event in our Thought Leadership webinar series, The Road to Glasgow, which is focusing, the series is focusing on sustainability issues. And I'd also like to thank our sponsors for this series of events, our platinum sponsor Milliman and our sponsor Star Actuarial Futures. Thanks very much to them for their support. This series is part of the Institute and Faculty of Actuaries, the IFoA's 2021 Thought Leadership Programme. We're convening leading experts, thinkers and decision makers with our global membership to debate the key sustainability issues of our time, which intersect both actuarial science and the interests of wider society. We're hosting this webinar series throughout the autumn ahead of COP26 in Glasgow. And it's my absolute pleasure to be chairing this series during my presidential year at what is a really critical moment for climate action. And throughout the series, we're providing a platform for prominent contributors so that our members and others can understand the perspectives of a wide range of parties interested in the climate debate. We'll also be promoting the actuarial contribution to addressing climate change and positioning the IFoA at the heart of key debates occurring against the backdrop of COP26. From the implications of the climate crisis for insurance and investment to the global role of actuaries, the path to net zero and the importance of biodiversity, the series will feature discussions across a range of topics relevant to the work of actuaries. Drawing on the expertise of a diverse range of experts from within academia, the financial sector, and our own thought leadership community around the world, this series is not to be missed, and I'm pleased that so many of you have joined us today or are watching it on catch up later on. All the events in the series are free to attend, and please do register online through the events page on the IFoA website. So today we're focusing on the implications of climate change for investment. Both retail and institutional investors have a huge role to play in how the financial sector addresses the climate crisis. Consumers are increasingly interested in how and where their money is invested, and COP26 represents a pivotal moment for how the industry reacts. The industry itself has signalled its intention to play a part in the global climate transition, with almost half of all assets under management now tied to the goal of reaching net zero by 2050. But are all these words, are they being underscored by tangible action? What more can the industry be doing? What role can governments and regulators play to facilitate the kind of progress that's required to move to net zero? And where do actuaries fit into all this? Over the course of the next hour and a half, our expert panel will explore these questions and as they reflect on the implications of COP26 for investment. So it is my absolute pleasure to introduce you to today's speakers. We have Steve Waygood, Chief Responsible Investment Officer at Aviva Investors. Steve founded Aviva's Global Responsible Investment Team, as well as its Sustainable Finance Centre for Excellence. He started his career at the WWF in '95 and subsequently advised the UK government, the European Commission, the Financial Stability Board, and the UN on the creation of sustainable capital markets. He was appointed to the European Commission High-Level Expert Group on Sustainable Finance and the UK Green Finance Task Force, and is also a member of the Financial Stability Board Task Force on Climate-Related Financial Disclosure. I think I got all those words in the right order, and I'm quite proud of myself for doing so. And Steve is doing a great deal to set the world in the right order, so well done him. We also have Catherine Howarth, CEO of Share Action. Catherine joined Share Action as Chief Executive in 2008, and she's a member of the Treasury's Asset Management Task Force and a board member of the Scott Trust, which owns the Guardian Media Group. And she serves on that Trust's investment committee. Catherine was recognised by the World Economic Forum as a young global leader in 2014. Finally, we have Mike Clark, Director of Ario Advisory, which is a responsible investment advisory firm working with policymakers, regulators, asset owners, investment consultants, and other finance sector actors. He represents the IFoA on the Advisory Council to the Oxford Smith School's Sustainable Finance Programme, and recently stepped down from an NED role at Brunel Local Government Pension Scheme. And he's been an active volunteer in the sustainability area for the IFoA for many years. So welcome to all three of them. Fantastic to see them. I'm now going to ask each of them to make some short opening remarks before we open up to a panel discussion and then questions from the floor. Please, the audience, you can submit questions at any time via the online Q&A function in Zoom. We won't necessarily, well, we almost certainly won't answer them as we come in, but you can put them in at any time and I'll pick them up in about the second half of this session. So, Catherine, I'll hand over to you first, and then Mike, and then Steve. So over to you, Catherine.
Thank you, Louise, and good afternoon, everybody. Those that are UK time zone, anyway. I never say no if I get an invitation to speak to actuaries, but I have to admit, I always accept such invitations with a bit of trepidation, because actuaries are people that really know what's what in finance. And so that's a little daunting, it always is. But anyway, I will do my best to say some things that I hope will be useful food for thought, and looking forward to the conversation that all of us will have as a panel in a bit. So this is about what will COP26 mean for investment. And of course, none of us know quite yet. And so whilst I very much hope that governments will surprise us on the upside by pushing through some really strong collective agreements and ratchet up their NDCs, it's all a bit beyond our control, and we will, I think, probably be better placed to have this conversation about what COP means after the COP. So I'm going to sort of focus on what does climate change mean for investment, because that, I think, is something within the control of actuaries and their clients, and not just within the control, but absolutely within the obligation, I think, of professionals and fiduciaries within capital markets to take climate change incredibly seriously. And I just want to start with citizens, and especially with savers, members of pension schemes and retail investors, because it's for them that we have to manage assets and money, well, certainly on the pension side. And I really think that it's sort of indisputable now that climate change is a major and pressing threat to their long-term interests, their welfare, and their financial outcomes. And what's very positive is that many citizens and savers are recognizing that. And there's a huge, I think, upswing in demand for more sustainable, more responsible, more prudent climate-related investment of long-term assets. But that isn't to say that plenty of people out there with pension savings really haven't got much of a clue about this. And that's, of course, why they have professional fiduciary investors and their advisors in the actuarial profession to help get this right and to manage what are clearly a very challenging and unpredictable set of new risks, but also, of course, opportunities. And so, yeah, I do just think that it's really vital that fiduciaries become fully engaged, and not just engaged, but really taking action, which I think inevitably with climate change, we're into a landscape where things are quite unpredictable. Now, I know that this is where we get into the landscape of what actuaries do, which is to manage sort of tricky risks and think about them cleverly. And so I've always thought that the actuarial profession needs to be totally on the front foot. And I'm delighted that the Institute regularly hosts these sessions. And Louise has been an amazing leader, I think, along with others, to ensure that the profession is fully engaged. But of course, there are regulatory shifts which are all pushing in that direction too. And I think it's to the credit of this government, actually, that we have some of the most sort of advanced pensions related climate regulation in the world now. And only at the beginning of this month, the new regs came in that require pension trustees to produce implementation statements, which produce, a level of accountability about how climate and wider ESG risks are being managed in investment strategies, and what action is being undertaken to manage them. So the regulatory environment is helpful, but we'll probably come on to the fact that far more is still needed. And the whole system is clearly moving into gear. And one has to acknowledge the very energetic work of Mark Carney running around the world, enlisting banks and asset managers and asset owners and insurance companies, pension funds to sign up to lots and lots of pre-COP pledging. So we're in a period of an absolute blitz of pre-COP pledging. And the question I suppose we have to ask is whether all of that adds up to enough to actually take us away from the brink of really catastrophic climate outcomes. Lots and lots of net zero by 2050 commitments, really few financial institutions that have set short-term science-based targets for sort of 2, 5 and 10-year horizons, horizons which are within the career trajectory of people sitting on the boards of those financial institutions. So the sum total of pledges that really give you a level of comfort in the very narrow window we have sort of in the next 10 years to really ensure that we don't tip over 1.5 degrees. The sum total pledges I don't think is very encouraging, really. And so the question then becomes, well, what more can be done, and what's the role of actors operating independently in capital markets, and what's the role of public policy to create frameworks in which we have the guidance and enabling requirements that push everybody in the right direction. So Share Action's done quite a lot of analysis and ranking of the world's largest insurers and asset managers over the last couple of years. And we've also produced quite a lot of sort of leading practice guidance based on identifying what the best things we observed across the world going on in both insurance and asset management. And I might talk about some of that later, not in this first 10 minutes, but I can say that a lot of really interesting and sort of quite ambitious work is being undertaken. And it seems to me that a large number of financial institutions could be stretching much further within the constraints that we currently operate in. But we need to kind of get beyond those constraints, which public policy could help us to do. But I'll come back and maybe report a bit later on what I think are some of the really interesting things being done in stewardship, in asset allocation, in governance, in training. There's just a multitude of things that are happening, but not on a widespread basis across the global markets. So then just to finish on some thoughts about, in a way, the limits of voluntary action, because everything that we're sort of pointing to in our best practice analysis and in the research we've done on what's happening in capital markets is all about, firms making voluntary pledges. And I think Steve might come on to the absolutely central necessity of a carbon price. So I'll leave that to him. But I will just say that I see, or Share Action sees, a really important constraint actually in the sort of current legal interpretation of investors' fiduciary duties. It's still the case that investors looking after other people's money really have to privilege maximization of returns, over the long term rather than the short, arguably. But I think that in a world of potentially catastrophic climate change, there are actually big problems with that interpretation of fiduciary duty just being really focused excessively, I think, unhelpfully on portfolio returns maximization. And I think rather than just maximizing people's wealth, we should think about maximizing the welfare of millions of people who, depend upon their fiduciaries and their advisors to secure their best interests over the long term. And last autumn, Share Action published a model responsible investment bill, setting out a kind of new framework of thinking about beneficiary best interest. Of course, financial return would still be absolutely center stage. And if you invest for a pension, you certainly want to have enough income to live on. But if your investments have contributed to a destabilized, perhaps more costly environment in which you, live out your retirement, then I don't think your best interests have been served. And our current legal frameworks for fiduciary obligation, I think, are not fit for purpose in the 21st century. So I hope that's a provocative little note to end on. And I'm very much looking forward to hearing what Mike and Steve say and to the forthcoming conversation.
Thanks, Catherine. That's great. So, I was hearing from you, we need action, not words. And in a sense, we need to look at the big picture. If you've got a lot of money in retirement, it's no use if everything else is so awful that money can't make up for it. So we have to think of the big picture. Mike, over to you.
Thanks, Catherine. Thanks, Louise. So I'm going to sort of pick up two themes from Catherine's remarks, and the first one is acceleration. So I'm going to focus my remarks on what investors are doing, with the message is it was fine what they were doing up to yesterday, but tomorrow needs to be a lot more. I think acceleration and focusing on the good things that are happening, saying the speed at which it's happening is not good enough. And also starting debate amongst the panelists, I'm going to pick up one of Catherine's earlier points. I'm going to suggest we know a lot more about COP than we might think, because in fact COP has been influencing behaviour quite a long time. So a lot of things we're going to talk about are influenced because people are thinking, as COP approaches, we need to put our best foot forward and sort of, be on the right side of the argument. So I think COP has been a massive influence in a way that we need to appreciate. Talking about what investors are doing, the first thing I'm going to mention is the Glasgow Finance Accord for Net Zero. Louise always picks me up when I use acronyms, so I got that in before I said GFANZ. So GFANZ is a, let's call it an umbrella for a series of sort of network gatherings around asset owners, around investment managers, around banks, around insurers. And it's part of the global architecture, which I'm sure Steve will talk about and we'll discuss. I was thinking as we went through the bios, I've never described myself as a disciple of Steve before, but I do it now. I think Steve has led some of the fantastic policy work and has taught me a lot. So one of the structures that we're building, and then we need to get to accountability. So one of the things, it's very easy, as Catherine said, to make these pledges. But one of the things that will be vital around these different sort of initiative streams. Many of the speakers will be familiar with the Net Zero Asset Owners Alliance, NZAOA, which I think was the first of the sort of children of GFANZ before GFANZ was there. So building accountability around those pledges to move everybody's behaviour on will be important. The next thing is that the leading asset owners have really moved beyond the traditional strategic asset allocation and are thinking of that much more as risk allocation. So, beta is a choice, it's not a given. So beginning to think about strategic risk management, which both informs SAA and actually informs their sort of ownership practices. I think strategic risk management precedes both sort of SAA and the engagement proxy work. I think that's just sort of a mindset evaluation, because SAA fits into the way we think about finance. But in one sense, it's inadequate. More locally, we have the Task Force for Pension Scheme Voting Implementation, apparently known as TOPSEI, sometimes the V is silent, TPSEI. This was a fine initiative launched by our pensions minister, who is one of our ministers who really understands the climate challenge. I had the privilege of working with DWP on the climate provisions of the Pensions Bill, now Act. And the Task Force for Pension Scheme Voting Implementation built on some excellent work, the Red Lines Voting Initiative, which Catherine would be involved in the early days, where we looked at the ways that asset owners, such as pension funds or others, could actually influence the voting, which is often performed by investment managers. This is a very interesting report. If you've not come across it, I commend it to you. Basically, there are some barriers in the investment management industry, which actually are much smaller than the investment management industry would claim. And if you read this report, which talks about the complacency of the investment management industry, Aviva accepted, of course, it's some really interesting ideas that pension fund trustees can offer an expression of wish, which the asset manager, probably ought to look at. So that is another systemic attempt to break down some of the barriers, and clearly voting around climate is one of the most important voting and indeed engagement issues. If we look at other good work, there is the IIGCT, and it's so long since I've thought what the words are, I shall stick to, I think, the Institutional Investment Group for Climate Change. Anyway, IIGCC, they produced a great net zero framework for investors. So that is a sort of guide for that sort of work. So there's lots of things going on, and I think part of sort of my goal for this session is to encourage people to sort of look at things they might have looked at, to pick up things and just accelerate the change. So at that point, I'll stop and hand over to Steve.
Oh, thanks. You caught me a bit by surprise there, Mike. I was expecting a bit more, but that's great. So what you're saying is, I think that there's a lot going on. Some of it is not as visible as it should be, and some of it does not actually go far enough, as far as it should do. So, Steve, over to you.
Louise, thank you. And thank you so much for your very kind introduction. Very comprehensive introduction. That was a little embarrassing. And Catherine and Mike, it is so brilliant to have such a nice amount of time to talk about such an important issue with you both, and full credit to all three of you actually for all of your leadership. And I want to use leadership as the theme for what I wanted to kick off with. And I am going to come back to lots of comments that Catherine made, and Mike, and you too, Louise. But I know this isn't good presentation practice, but I want to start with a quote by reading you something from which is about an actuary who inspired me to join the industry some years ago. So let me read you a paragraph. The cost of natural disasters, and by the way, this is from the Irish Times, the cost of natural disasters associated with climate change is likely to bankrupt the world economy in 2065. The insurance industry's leading expert on global warming warned here yesterday. Mr. Andrew Dugalecki, director of CGNU, one of the world's largest insurance groups, said the bill for property damage caused by storms, floods, and other natural disasters was rising by 10% a year. Now, a few things to observe about that. Firstly, for those of you who've been in the industry a while, you'll recognize CGNU. For those of you that have joined in the last 10 years, that used to be Aviva. Some of you may remember Andrew Dugalecki. He was an actuary. He is an actuary. He certainly inspired me in the 90s to get involved. Actually, Louise, do you remember Andrew?
No, I don't. No, sorry.
But, so there were people like him and Richard Tapper in the 90s in our industry, in the insurance sector. People also at Swiss Re and Munich Re, mid-90s, early 90s, people were talking about this. The article I've just read you sounds like it was written yesterday. It was written 21 years ago, November the 24th, 2000. Now, first of all, leadership. It's important that people like that took the leadership they did so that we can all be here talking about what we are, and that COP26 can have got to where it is. But 21 years. 21 years. I want to just really, really emphasize that that is way too long, and we need to now act at a pace and scale that is literally unprecedented in any of the previous 3 industrial revolutions. The 4th industrial revolution, as it's described, this how do we approach the Paris Agreement, this move away from fossil fuels to renewables, it has begun. We are beginning it. It is wonderful to behold what's happening to costs of capital of the renewable sector and also the fossil fuel sector, but it's nowhere near fast enough, nowhere near. And I just want to a cri de coeur to all of the actuaries here. Andrew recognized, he got the date perhaps a little bit wrong, but he recognized the scale of the importance of this challenge. We've done studies with the Economist Intelligence Unit that suggest 43 trillion would be wiped off the stock of capital by the end of the century. 43 trillion, the net present value in 2015, that was. So it's nearer 200 trillion if you cast it forwards to 2100 using the discount rate they were applying. This is a potential catastrophe for our sector. It's an existential crisis. In fact, not just for our sector, but if we tip, banks follow, capital markets follow, not that far after, you could say civilization itself will be tested. And currently we're heading towards a future in which that is the reality. We haven't yet applied the Paris Agreement. No one's applied the brakes anywhere near hard enough. And this is the cri de coeur. We are, as the insurance sector, we should be the canaries in the cage in the coal mine. We should have been, and we were actually, some of these people like Andrew and others should have been calling as loudly as they possibly could to arrest the development that was on a fossil fuel basis. They weren't successful. Now, if you look at how much the fossil fuel sector has spent in the last 21 years on advocacy for their business model, it comes in at over 2 billion. Now, we as a sector, if we were really caring about the long-term fiduciary duty of our beneficiaries, or our fiduciary duty to our beneficiaries, as well as to our shareholders, those of us that are listed, we would have been equal and opposite and arguably should have been greater in terms of a force for change than they were a force for stasis. And we failed. We've spent less than 1,000, would be my estimate, on advocacy in our own long-term interests. Think of what physical risk does to all our actuarial models. And as the rate of change is now speeding up, you can't simply have it as a backward. I can see Mike's put his hand up. Louise, you're shaking your head.
Well, I'm just shaking. Yeah. Sorry, what you're saying. It's just
the scale. So Mike, you want to come in? I'll carry my flow on in a minute. But what do you want to say?
No, I do. I just want to pick it up and sort of go off piece and slightly sort of confuse Louise. But I think that's so important because when we get to the way that regulators are only getting to that point, and one of the things we can actually do is generate competition between regulators, we believe. So I think the issue you identify has been picked up by IOPA. I don't think it's really been picked up by the PRA. And one particular thing which I'm now spending some time on is this annual repricing in non-life insurance, which totally ignores the systemic risk of a sort of cumulative, aggregating risk. So I think that, IOPA have identified the fact that if you're the reinsurer and I'm the insurer, our contract just doesn't capture the systemic risk that is growing beneath us. So I think there's some really interesting systemic barriers that maybe we can sort of draw out in this session. So I just wanted to do that. And if IIGCC is the counterweight to Exxon lobbying, we have a problem.
Indeed.
Asset owners,
indeed.
Their own, lobbying is not a dirty word. It is just simply telling people we have a view which we wish to share. So I just wanted to pick those up.
Thank you, Mike. So I'll come back to those comments actually, I think under the Q&A, but going back to where I was heading, I think as an industry, we should really hang our head in shame for our failure to deliver on the long-term best interests of pension beneficiaries and delivering on our fiduciary duty for shareholders over the company law time horizon, which is actually future shareholders as well as existing ones. Now, we can do much more to stop the physical risk actually ever manifesting. And with the kinds of net zero commitments that Catherine referred to, it's almost, people are now assuming that the more than 250 organizations, the more than 88 trillion that's now signed up to the Glasgow Financial Alliance for Net Zero that Mike's already mentioned, that people are assuming that those 250 organizations will sort it out for us all. And Catherine's absolutely right to say that not many of them have got the targets that we put in. By 2025 will be 25% less, by 2030 will be 60% less, by 2040 we aim to be net zero on our full greenhouse gas suite of relevant emissions on scope 1, 2 and 3, to go a little bit technical. That's a hugely ambitious, it's almost ridiculously ambitious agenda to set. And the thing I want to flag, two things. One, it's comply or explain. So people, as you're not forced to deliver it. It doesn't override your fiduciary duty to clients. If doing the wrong thing from an investment perspective pays over the investment time horizon, then it doesn't overturn that. It's an ambition. It doesn't overturn law or fiduciary duty. The second thing, all of the net zero statements, Catherine will know this, and so does Mike, all of them include a caveat which says we're assuming that government policy will continue to change so that they themselves are powering a transition towards net zero. So the bit that matters here is the interface between now the few hundred finance ministers and central bank governors that have really woken up to this issue, most of them in the last 12 months, almost all of them in the last 2 years, with the honourable exception of the already mentioned Mark Carney. Now, there's 200 now people at the tops of finance who control national regulators of banks, insurance and investors, who now recognise that climate change is going to represent that existential crisis. And that's an audience for us as an industry to harness markets so that they deliver the change that we need to see in all of our interests. So that, as my 11-year-old daughter put it when I explained to her what I did for a job, she said, "Daddy, does that mean money is destroying money at the moment?" And it is as simple as that. It really does come down to that. Not quite this year or this decade, but certainly this century. Money is currently destroying money, which is not clever, and it's certainly not prudential. And the current structure of the prudential regime is actually undermining the future interests of our beneficiaries and our industry's shareholders. So there's a lot to be said about what's on the table for COP. They're talking about a revolution in reporting. TCFD will be mandated in G7 countries. Fantastic. We already now know that, as Mike said, because it is the UK and Italy that are the co-hosts of COP. And coincidentally, we're also the hosts of the G7 and the G20. The first time that geopolitical alignment has ever existed in the 27 years that the UN Framework Convention on Climate Change has had a conference of parties. So why don't we do that every 3 years, have the two co-hosts of G7 and G20, the two co-hosts of COP, because it made masses of difference to what can be done with the markets. You don't control the markets by treaty at the UN. So that matters. The reporting, there's a huge amount more data supposedly coming out on risk. So reporting risk, returns. They wish to be advocating now more for the amount of money that can be made by investing in solutions that power the transition. And then the fourth element of the private finance hub, which is Mark Carney's unit at the Treasury, in terms of what they seek to achieve at and around COP, is about mobilizing the scale of capital required to deliver the Paris Agreement, which there are various estimates of, but a reasonable one is around $2 trillion a year, which is 8 times what it took to put a man on the moon, plus rebuild Europe in present prices to combined each year, 8 times that each year. It's a lot of money. So it's a real problem that no one has a vision for how you harness the entire international financial architecture to deliver the Paris Agreement. We've got bits of it. Mike's pointed to a few anomalies already. We also don't have a process yet that brings together all the agents within the international financial architecture. We have the COP that brings the countries and their foreign ministers together. It doesn't bring the finance ministers systematically. It's only recently that they've ever started to turn up. My first COP was COP4 in 2000, and there were no other financial institutions at all, let alone any other central bankers or finance ministers, they've only started turning up in the last few years, to be honest. And in fact, in Glasgow, I think they're going to find it difficult to fight them out. There are people who are now clamoring for tickets and can't get them. It's really interesting to see the shift. So there's a massive opportunity to do more, to harness this international financial architecture. And we need a vision. We need a set of plans at the country level for delivering each nationally determined contribution. And then we need a process that brings together all of the institutions of the international financial architecture, by which I mean the multilateral bodies, World Bank, IMF, IFC, etc., as well as the international regulators like IOSCO, FSB. I'm going to be doing a mic now and listing a whole series of abbreviations, but we know what they mean. And then IFRS, the accounting system, FASB as well, the American version, and then up beneath the standard setters, then the central banks and the finance ministries, and beneath them, the national regulators of markets. They all need to align their mandates and their work program to 1.5 degrees in order to be able to deliver their work program. Because if they don't, then they're falling into that tragedy of horizon and only thinking about the next few years. And Louise, I could continue, and I think I've done more than 10 minutes, but Mike had 3 of them. So back to you now.
Yeah, no, I mean, I think what we're all saying here is that we are hearing a lot of words. We're hearing a lot of corporates, we're hearing a lot of governments, we're hearing a lot of investment industry participants make ambitious commitments. But what we have yet to see is really the actions that are going to bring those commitments to fruition. I was very struck by something you said, Steve, about the the oil majors in particular, but the fossil fuel industry in general as being a force for stasis rather than a force for change. Isn't that true, though, of the whole investment industry, that actually people want things just to, I mean, not obviously some honourable exceptions, but I mean, people on the whole want things to continue as they are. And they have this false dichotomy between changing, which is going to cost money, and they don't really know what the outcome's going to be. Are all these things actually going to work? And continuing as we are, without realizing that continuing as we are is simply impossible because the world is going to change around us.
What an interesting point. So I think that's the cultural shift that we've seen in the last 12 months in finance. And I think at the top tables of these financial institutions within the governance bodies, there is now recognition broadly, not of the urgency and of the cataclysm if it's not delivered, but there's the broad recognition of the science and that we've got to get on with something. They don't quite know yet what, but the top table gets that change is necessary and innovation is required. And ultimately, actually, markets matter and ESG pays right now massively. So everybody is at least pretending to have drunk the Gatorade, even if only a few really have and understood what it means. So the bit that's true of what you say is, obviously, if you're a fund manager and you've positioned a portfolio based on analysis that suggests one thing is the future, you're unlikely to then lobby for a different future. And so there is a truth in what you say though, Louise. And I think that's been what's held back, actually, finance from being as honest and blunt as I have been in the last 10 minutes. So yes, you're right.
Yeah.
Mike
and then Catherine.
Yes,
Mike.
let me pick that up. So the answer to your question is yes. And I think being slightly more on the edge of the system than Steve, I can be a bit more assertive. And I'm going to make some remarks and end up with the question of the panel, which you can answer as well, Louise, and it'll be about fiduciary duty and lawyers. So one of the things that, how should I put it this way? So we spent a lot of effort, I was privileged to be part of it, in getting 3 people on the Exxon board. Should, in fact, we'd be spending our efforts getting the risk rules changed under which we operate, but in fact, Exxon just changed behavior. That's one way of sort of looking at it. A term I think I can claim I learned from Steve was macro stewardship. We spend a lot of time on downward stewardship into companies, but we need to spend much more time helping those at the top table, because in fact the people at the middle table have sort of been on this for 10, 20 years, but the top table is there now. So we need much more, influence, because I think influence is a better word than control, but we need much more influence on the policymakers and regulators to move the, if you like, the risk dial so that policy accelerates. And I think the changes Steve has made means that is beginning to happen. And I think the notion of macro stewardship, which is upward stewardship, which is lobbying, which is combating, if you like, the stasis, is a clear thing. And one of the things which, again, I'm going to embarrass Steve more, which I think I learned on an event that Steve was hosting, was this notion that fiduciary duty could be expanded to include a responsibility of asset owners to the stability of the financial system. So we've historically thought that these independent central banks, and of course they're not really independent, these central banks are responsible for the stability of the financial system. But my question would be to you three, do we know of lawyers who are beginning to have a conversation about fiduciary duty, including the stability of the financial system? So I'm going to put that as a question to the panel.
Ollie, Catherine, do you want to pick up on this?
Yes, I don't think it's your job to put questions to the panel. I think that might be Louise's job. Anyway, yes, I can only agree. And it's a shame that I do. I think there's a lot of recognition now that this might be a really big problem, but incredibly minimal appetite to take anything that looks like a short-term, painful financial decision to put that, and so to put that right. So, I mean, actually, the total financing of the fossil fuel industry has gone up and up every year since the Paris Agreement was signed. I mean, that's so shocking when we've had all this conversation, not just going back 21 years and longer, as Steve said, but intensively in the last few years. And the reality is that we'll be a huge amount of work that we've done at Share Action on the banking sector. And, banks are very engaged, very interested in kind of green financing opportunities, because that, there's lots of upside there, and that's very exciting and absolutely necessary. But actually, we also really do need to scale back financing of carbon intensive assets. And there's just incredibly minimal appetite for that because there's still money on the table. And so either, now what's beginning to happen, which is very encouraging, is that long-term institutional investors with holdings in the banking sector are starting to hold banks accountable. And I'm really encouraged by the quality of the conversations that are taking place with banks in Asia as well, where there's, that's the region with the largest sort of ongoing and new financing of fossil fuels, but across Europe as well. But I think it all feels very, very minimal up against what we need to do. And so whilst I think absolutely every financial institution must do everything it can, and that the point I was trying to make earlier in my presentation was that I think there's just a lot on the table that can be done totally within the current rules of the game. But also, to Steve's point, we have to shift the rules of the game, and we need collaboration and a very concerted focus by institutions that take a really long-term and enlightened perspective on their, not just on their self-interest as institutions, but on their obligations to clients and beneficiaries, that we push really hard for the rules that will unlock the acceleration now needed.
I'm not going to answer these questions because I'm not here to answer questions. I can put other questions to the panel though. Sorry, Mike. Does the investment industry, and obviously there is no such thing as the investment industry, there's just a whole lot of players all with slightly different views, etc., etc., etc. Is there a widespread recognition that their future is at stake here? That if everything goes wrong, there will not be an investment industry as we know it. So that by investing in fossil fuels and so on and not taking other actions, they are contributing to their own downfall.
That's a competition question. The competitors will be there, the ones who lose the competition won't.
Can I build on Mike's answer there for you, Louise? And I'm sure Catherine will want to come in as well on this. So I think the blunt answer is no, there is not recognition of the reality that you just described. I believe what you say is true, and it is painful to say, as Catherine suggested earlier, but it is, if you read the science, and fortunately we don't have to read all of it, there's an assessment conducted, and I'm not sure all the people watching will know about that. The International Panel of Climate Change have just published their 6th assessment report. There is a summary for policymakers, which itself is pretty meaty reading, but that's assessed the last 7 years worth of the science. If you read that, brace yourself for a pretty dismal read, but it is unequivocally clear that humanity is causing climate change on an unprecedented scale. And it is equally clear if you then read it alongside a report that came out a few years ago, the 1.5 degrees report from the United Nations Environment Programme. The science suggests, and this will be challengeable but broadly right, that roughly 3/4 of the world's population will not be able to live where they do midday, midsummer, because 20 years or more of the summer, 20 days or more of the summer, will be too hot for their body to function. The internal organs will start to shut down because the wet bulb temperature will be more than 35 degrees, which is a measure of a thermometer wrapped in water, effectively, with a wet bulb. It means just that. The human body will close down. So either they will die or they'll need to emigrate. Now imagine what 3/4 of the world's population emigrating looks like politically. Now we structured the economic system post Second World War to foster international economic integration so that people would rely upon each other and never go to war again. That was intentionally part of the Bretton Woods program. We would restructure global trade to foster economic interaction so that trading partners wouldn't go to battle. So it actually worked reasonably well. Look at China and the US at the moment. Worked reasonably well. However, the current structure of the markets, I think, is now predictably going to be causing at least civil war. Possibly, even just looking at Ethiopia and Egypt right now with various dams being built, could be doing much more than just civil war, could be states going together, and it possibly could precipitate a third world war, which is why NATO and the Pentagon and MI5 and others like them now have teams of people looking at climate change from a national security perspective. So this, honestly, I find the lack of recognition of the answer to your question to be really it's both incredibly disappointing as also an opportunity, because when they wake up and they realize that to deliver net zero, which we must now do, the way of doing that is to engage with governments and policymakers and politicians and encourage them to do everything they possibly can to restructure markets so the incentives reward the right thing and punish the wrong thing. That requires policy around fiscal measures, market mechanisms, standards, regulation, a whole series of trade rules and so on. We can do it. We know we can. We even know how to. We just need to have a political sector globally and a financial sector globally that realize that actually there's one or two sectors only that will suffer really from transition risk at any scale, whereas everything else suffers inexorably if we don't transition. So for me, the only just transition is one that we just get on with. Mm-hmm. Louise, I could carry on, but back to you.
Okay, I'm going to start picking up some of the questions from the audience, I think. One thing I'm keen to think about over the next half hour or so is what different actors can do. And I'm going to pick up Sandy Trust's question, which is, he's worried about carbon literacy in financial services. So his question is, how do we increase the level of carbon literacy so that broadly people understand the level of risk, and then incentivize people to take action in financial services? And I think here he's probably talking about people in the financial services industry, though of course it applies to pretty much anyone. But from the very top board levels of the big investment houses and so on, down to your local high street bankers, how can we get all these people to understand the problems, understand what's going on, and think about what they should be doing about it? Mike.
Oh,
that's a great question. Firstly, they need to learn about emissions trading schemes and preempting one of the questions that you might have asked, whether ESG ratings are going to help with the climate change, let's answer that quickly and say, no, they're not. And Steve, I think, will nod. So carbon pricing is one of the ways that the real world joins up with the finance world. Many people may not realise the EU ETS price has moved from €5 to 60 in the space of 3 or 4 years. That during September, although the EU ETS price only went up by 3%, the UK one went up by 40%. In the States, RGGI, and I have no idea what RGGI stands for, sorry, it went up by 20%, and the California one went up by 10%. So although we've read all the newspaper reports about gas pricing problems, it sort of spills in. So one of the things I've floated that hasn't yet gained much traction is that when the Treasury and BEIS get together, they should publish a forward carbon price policy curve. They should then instruct the Bank of England to form open market operations in the UK ETS to keep the price within boundaries, which keep it moving upwards, but don't get to today's point. So there's lots of things we can do in the sort of economic policy space. One of the things Steve told a wonderful scare story about Egypt and Ethiopia. One of mine is that in the UK, the Treasury presumably hopes that the PRA has the banking sector regulated, but let us take the PRI's inevitable policy response, IPR, and maybe in about 2025, there's this sort of inflection point, and without being too unkind to economists, they're not very good at inflection points and forecasting, but the risk thing. We have a situation where all of a sudden the banks with all these fossil fuel loans on their books decide that they can't cope. So in fact, despite the excellent regulation that Sarah Breeden and friends are leading the PRA, we certainly have a bit of a banking crisis, because all of a sudden the banks have realized that this risk is not one they want on their balance sheet. So there can be a bit of a disconnect between public policy, the Treasury, and financial regulation. So I could tell another story about insurance, but I won't.
But I think let's let someone else get a word in. I mean, I'm thinking here that what I heard you say was carbon pricing, because that basically hits everybody's pockets, and that will focus minds amazingly. Catherine, what do you think we should be doing on this?
Well, I love the sort of practical nature of Sandy's question, and this is sort of perhaps gives me an opportunity to say some of what we observed when we kind of had a good look at the global asset management and global insurance sectors over the last couple of years, sort of good practice. And so mandatory training for all staff throughout a financial institution on sustainability and specifically climate related risk is unfortunately incredibly rare still, but a good example of that is actually Cathay Life. We really liked what they were doing on that. Executive KPIs that drive sustainability and climate goals. So you've got all these organizations with their net zero pledges. Where are the ones where KPIs for senior executives and actually cascading right down are fully aligned with that, so that you've got the right incentives? Well, again, an insurance company where we really liked what they were doing on executive KPIs was Generali. And then there's this whole question of what kind of level of expertise is sitting on the board and informing strategic board level discussions. Again, very few financial institutions have people with serious, credible backgrounds in transition or climate science, or some of the key skills that would be relevant to help understand the risks and drive them. But we were really impressed with AXA's board from that point of view. And then stewardship is just so vital now. Now, I know it's not an actuarial sort of skill set particularly, but I really do emphasize that, and Aviva is wonderful on this, but there are other really good examples of firms that are actually making use of the shareholder rights that they've got and using them slightly courageously. I mean, the level of timidity. So there we are saying, this is really important, really serious issue we've pledged, but merrily voting through the re-election of directors of investee companies that are utterly failing to take even the baby steps that we know are necessary on this. So that's got to stop. And I do, by the way, think that there's potential for litigation risk here. I think if you've said that you're a kind of net zero supporting institutional investor, and you continue to vote through the re-election and support the full sort of AGM slate of management-led resolutions at companies that are clearly running unmanaged climate-related risk, you yourself put yourself at risk, I think. So I think that's coming down the track. So those are some of the things, and they're also doable, actually. And again, on the stewardship, we should be asking investee companies whether they do have board members with the right skills, whether the executive incentives are aligned and the KPIs are there, and whether the training regime are there. So those are all, they just feel so doable at this point. And there are examples of good practice across the industry, but just not enough widespread application of them.
And do you think that shareholder pressure, and I mean, it's more than shareholder pressure, it's societal pressure. Do you think that's enough, or do we need some kind of regulation? Or
so I don't think it's enough. I think it's really important and underused. And I, rabbit on about stewardship quite a lot and really believe, because I've witnessed how powerful it can be when investors actually do use the tools they've got stewardship wise. But of course, it's not enough. And actually, we also need to have quite brave asset allocation debates as well. And, what are we willing to invest in? There's still, again, huge numbers of financial institutions with net zero pledges that continue to be very happy to refinance coal-related bonds, to hold companies that are absolutely dependent for their future financial growth on expansion of the coal sector, totally in contradiction to what we need. So I think really liked, if you want to see a good coal exclusion policy, AGR2 La Mondiale, a French insurance company, really strong, interesting policy. On unconventional oil and gas exclusion, some really tough thresholds set by ACMEA, really good examples. So scattered across our industry are some really good examples of what, if everyone was doing it, then not that that would be the full solution, because I do think we need some of these more systemic policy-driven fixes. But what I am saying is that without those, there's still a lot of opportunity on the table that could be grasped, which would see acceleration in the right direction.
We need to tell good stories as examples, and we need to tell scare stories. Here's my 20-second one. I have helped a firm of lawyers review an actuarial valuation to wonder if the actuarial advice was taking sufficient notice of climate change. I hope that scares a few attendees.
So, Steve, if you can sort of think about this. So we need societal change of mood, as it were, and we're getting that to a certain extent. It is, I mean, it's changed so much in the last 2 or 3 years. I think that's fairly obvious. But then how do we turn that into the political action and the financial action that's needed? Because I think governments are generally scared of getting too far ahead of their citizens, as it were, and the citizens are not surprisingly, naturally quite influenced by what their governments and politicians are saying. So it's quite difficult to get this rapid change happening. And is there a role that we, the financial services sector, can play in this?
Sure, there must be. I mean, you speak to this, Steve, but I would say absolutely that, capital markets actors are hugely influential, and I think are starting to get organised to send these messages through. But in the UK or Europe, our version of this is the Institutional Investors Group on Climate Change, which is a valiant sort of NGO effort, in effect, and it's not resourced to the level required. So we've got that's a point Steve's already made, but I think it should be remade. Go, Steve.
Catherine, I couldn't agree with you more. I think you said it very well. And I just build on what you said about stewardship or micro stewardship with companies. If you think about it microeconomically, I think that is absolutely critically necessary, but it is critically not sufficient either. the bit that we need to deliver as well as powering a transition with the companies we own, we can only push them as far as the market will reward them to travel. So we can push them to exploit market inefficiencies, we can push them to be eco-efficient, we can push them to do the right thing, as long as it's rewarding their pay structure, crucially, as well as their cash flows over their investment time horizons, so say the next 3 to 5 years. As soon as you start to find that doing the wrong thing pays companies, like dig it out the ground and burn it, as soon as you're finding doing the wrong thing pays, that's a market failure. That's the market has not been corrected to lead to optimal outcomes for society. That is the classic definition of a market failure, which is what provides space for government action. It's, I think, Milton Friedman's legacy that free markets work optimally for social well-being. It's absolutely nonsense. They absolutely do not. And in this case, climate change is the world's biggest market failure, which brings me to the point Mike made earlier about macro stewardship, and Louise, possibly the most important answer to your question. In my experience, politicians and policymakers tend not to have worked in finance anywhere, whether it's banking, insurance, or investment. There are some exceptions. They are enamored, though, by the market. And if market practitioners come to them and say, we are concerned about the financial well-being of our clients, they listen. They really listen. Far more, in fact, than if you come from an NGO saying, I'm worried about the penguins or the pandas. I know this because I used to work at WWF. So now, going to them and saying we are worried about long-term shareholder value creation, erosion of value for our shareholders, destruction of value at the scale that climate change precipitates, they listen. They really listen. So I think that therefore it's incumbent on our industry to use that influence to change the system itself, to internalize the externality, as it's referred to in the economic literature, and to do what we can to power that transition. After all, in the UK alone, we have 19 million customers. And reaching out to them, as we will be, to educate them about why COP matters and what we can do on their behalf and what they can do on their own behalf to power a transition. That is crucially, there is, sorry, last point, Louise, I know I'm speaking for a while, but just Mike asked a question earlier about fiduciary duty, and Catherine referred to it as well. The clause in European law, and that underpins the Financial Conduct Authority's work. The clause that matters most isn't around fiduciary duty, actually, because we've had a debate about that. I think it's reasonably, well, it's vividly clear now that we all have a duty to integrate ESG to optimize long-term risk-adjusted returns. That is now clear, and that's supported by DWP guidance. What isn't as clear is that our duty to maintain market integrity, which does exist in law, is that just about not front running, not insider trading, not mis-selling, or is that also about maintaining the integrity of the system itself and doing what we can to recommend to FSB, PRA, IASB, etc., what to do something differently to maintain system integrity? And my contention is that it is actually exactly that. We have a duty to maintain integrity, system integrity, which is now being tested by not just climate change, it's also biodiversity and species loss, which ultimately will come back and harm just as much. But this focus now, macro stewardship, I think our industry is woefully inadequate at it, and it is implied in every net zero statement, and we need to get much better. I'm not sure we need to be investing the billions that the oil and gas industry have in stopping it, but we certainly need to invest more than, let's be honest, £500,000 that is roughly IIGCC's budget. I'm guessing that's roughly right.
Can I build on that?
Right, go on.
I think that's the conversation that we need to have. Steve has probably one of the best insights there is for the need for that. I think I use the word stability, integrity is a much better word, system integrity. We might even weave in Nick Spencer's excellent question in a moment. But I was having this very same question this morning with a new employee at the PRI who has a wonderful title about helping asset owners to do better or something like that. And I was encouraging her that as the PRI evolves, it needs to get much better at this for very understandable reasons. It's been very cautious about advocacy. But now it is in a very powerful place, I was suggesting, to take on this advocacy role. They've already started, like all these things, there's work streams in process about the financial system. Actually bringing the rules of the financial system, because financial regulators only have the tools to regulate financial risk. The risk gap between societal risk and financial risk is huge, to Steve's point. That part of this integrity is bringing together two different, totally divorced systems. Financial risk, as we understand it, you know, for people like us, it's sort of alpha, beta, CAPM, and a few more acronyms, and SDG risk. Bringing those together is effectively systemic integrity, it's human integrity. So I think this is a place, I don't often bat for a profession like this, I think this is a place where actuaries can have a really good conversation, which effectively leads to more influence into the system, because it is about systemic integrity, it's about risk management. The fact that governments have been very poor chief risk officers, and we need to get governments being better at chief risk officers, which reframes the risk under which Exxon works.
I'd like to move us on a bit. We've got several questions coming in, but I'd like to move actually on to Nick Spencer, who's said, is there a risk the voices of the global south are being underrepresented in COP26 and being excluded from ESG tilted and net zero investments? Should we expect the global south to reach net zero at the same time as the global north? And if it's different timelines, what does that mean for investors wanting to align to a net zero target? And I think we need to relate that discussion back to the concept of a just transition. That we mustn't say, oh, well, the global south, they're burning all this fossil fuel because that's in some cases they just don't have a lot of choice. Therefore, we are not going to invest there. We're not going to support them, because that is really sort of making things even worse for the people who are going to suffer most from the physical risks anyway. So what do we need to do about this in what is, after all, increasingly a completely globalized investment industry? I see all three of you nodding. I'm going to go to Steve first on this one.
What a brilliant question. So the answer is yes, they are being inadvertently excluded, and some of that is to do with COVID and vaccines and so on. Although I would give full credit to the COP team for trying to overcome that. It's obviously a massive logistical challenge. And I do think it is important that we do just get on with COP rather than defer it again. It's already a year late. And it will be Egypt now, we understand, that will be hosting COP27 next year. I think possibly for reasons I referred to earlier, but Egypt will be easier for obviously a lot of the African delegates to go to, but not everybody. So let's accept that unfortunately there are massive logistical challenges that are beyond anyone's ability to deal with right now, which is unfortunately meaning that they aren't attending at quite the rate that they were hoping to. I'd also think it's a shame that the IT systems in their country haven't been addressed, as well as the vaccines. We could have seen that one coming. And I think, Mike might remember about a year ago, we did try and catalyze a few very large IT businesses to reach out to the negotiating teams in many of the countries that would otherwise not be able to attend and give them free kit. That didn't happen, unfortunately. So I think that was an opportunity missed. In addition, if you think about their interests more broadly, it's not just accessing a COP, it's accessing capital markets. And they do that in different ways. Sovereign debt, they do that through supply chain finance, they do that through foreign direct investment, and they do it through direct portfolio investments into their country's exchange, if they have one. Now, analyzing development impacts across those four supply chains of capital, if you like, it's clear that they're being excluded there too. And they're actually being excluded often just because of the norms and conventions of the way we run money in the developed north, if I can use that euphemism. We use an all-share benchmark. We use a developed market benchmark. We look to MSCI's developed market because we consider it lower risk. It's also potentially much lower return than going into emerging markets, which are obviously more volatile. But the consequences of that are that it's much more expensive. For the greatest need of capital comes there. It's also the greatest cost, but the greatest reward, because equatorial countries obviously have more sun. and therefore renewables work better in that space. So the return on capital employed from a carbon perspective is certainly greater. So there's obviously more to be said about the historic the historic imbalance, the historic atrocities that have led to the deep dislocation of some of their economies. It's also very interesting when there have been various studies of, if you aggregate the totality of the land use changes and climate emissions from fossil fuels, countries like China and India and Indonesia are in the top 10 historic climate destroyers. They're not top, that's the US, and the UK is in the top 10 too. But it isn't just north-south, actually, in terms of legacy. So that the answer to that part of the question is no. However, the historic legacy does need to be adjusted for. And I think that's why I think the OECD needs to play a role with nation states, helping them to change their policy framework so that their own cost of carbon is material. They have a carbon price that changes capital flows, and the OECD should be reaching out to the developing countries, advising them on how to access markets in the rich country club that it is effectively representing. And we've been working for about a year and a half now, trying to propose an international platform for climate finance to do just that. And I'm very pleased to say, last point, Matthias Cormann wrote to the finance ministers of the G20 a few weeks ago, offering the services of the OECD to advise nations everywhere on how to maximize a carbon price. So it's happening, but not enough.
Mm-hmm. Thanks. That's great, and I think it gives plenty of food for thought to all of us. Mike, did you want to come in specifically on that, just briefly?
Yes. No, I think there's a very key point building on this. So I think just absolutely supporting this idea that the OECD are there. A phrase we don't hear very often these days is this common but differentiated responsibilities. I don't know if it still lurks, but I think that speaks to Steve's point. A very specific one is that the Western capital gets worried about the sort of volatility of some of the currencies where the capital might need to be invested. So some of the things Steve has talked about has a major role for some of the MDBs to take on the global societal risk, find ways of hedging the currency risk, which will reduce the risk of Western capital, which might otherwise not want to invest in 25-year return stream of Indian rupees. So to Steve's global architecture, I just make the very specific point about the currency volatility and therefore risk can dissuade Western capital from doing what it needs to do.
Great. We've got time for just a few more questions. I'm going to pick up. We've talked a lot about net zero, but what I'd like to think about is what it actually means in practice. So we've got a question from Robin Smith here, talking, I think, about a pension trustee board. If a trustee board signs up to net zero 2050, what obligations is it committing to? What actions will it have to take? But I'd like to expand that a bit more broadly, not on necessarily sort of formal obligations, but what do we think net zero should mean in this context for some of the actors, if you like, in the investment world, some of the participants in that value chain? Catherine, would you like to start off on this one?
Yeah, so obviously these are all voluntary pledges at the moment. I just emphasised that earlier. But nevertheless, what could it look like? Well, it certainly ought to look like a commitment to kind of scenario test what your current kind of asset allocation looks like, and what temperature goal that's aligned with. That's kind of a complex technical, and there's lots of people trying to develop a methodology, but at the very least, making sure that absolutely all the asset managers that are providing investment services to your trustee board provide, ideally 6 monthly, but certainly annual sort of reporting on what they're doing to ensure that they're sort of tilting actively, if it's an active portfolio, away from brown and towards sort of green assets, and that they have an active stewardship strategy to encourage all of the underlying holdings to to have their own climate transition plans. I mean, every public company and indeed large privately held companies should have a published climate transition action plan with short, medium and long-term targets. And so if you're a net zero pension fund, you need to be making sure that year on year, the overall kind of exposure you have to companies that have those plans is growing. And then I think, you know, it's also about having a training program for your trustee board so that they're really competent to evaluate and report on their progress year on year. Now you do have to have these sort of implementation statements each year you publish as a UK pension fund trustee board. So that's quite helpful. And I think although the guidance is very minimal on what that looks like so far, I think we will start to see quite good practice emerging, and hopefully that will spread and the pensions regulator can have a good role in providing some kind of more useful guidance on that. So those are just a few immediate thoughts about what the kind of things that you could do. It's really making sure that you've got, and then corporate bond portfolios, again, it's very, very minimal what's going on in corporate bond portfolios on a climate related basis at the moment. But I really don't think if you've committed to net zero, you should be refinancing or buying bonds from entities that don't have a climate transition plan that's credible. So those are just a few thoughts.
Mm-hmm. So I guess it's partly about not relying on failure to achieve net zero to deliver the returns that you want. Because I mean, that just seems to be asking for trouble, really. If you're relying on things going wrong for everybody else, for them to sort of go sort of right for you. Mike, you've got your hand up.
We can spend a lot of time discussing what net zero means. There are probably 20 things everybody could do. Just spend a little moment deciding the 3 you're going to do, get on and do them. Don't discuss what it means.
Mm-hmm. Yeah. Steve?
Can I just to add a little to, I completely agree with everything Catherine and Mike have both said. And just to help a trustee who really wants to understand this, bring it down to the practicalities, I would say the UNEP Finance Initiative, the UN Environment Programme, has convened the Net Zero Asset Owner Alliance. Join that, or at least read its website. And it has on there a page, that's all, which sets out what the institution is committing to do. I've got that page in front of me. There is a fee. It's not material. If you've got less than 5 billion assets under management, it's 5,000 euros. I have no interest. I'm not. We've got those shares in them, although we are a member of this. We're paying the 20,000 fee. But you're committing to measure progress, set targets, as Catherine has said, report against progress, and then work together with everyone else. This is a collective action problem, so you're committing to taking action collectively to try and encourage companies and countries to change. And just to amplify Catherine's point around corporate bonds, it's also government bonds as well. We've, in the last 3 months, we've had 3 different countries come through our macro team, all of which have been challenged for either not being a member of the Network for Greening the Financial System or not being a member of the Finance Ministers for Climate Change Coalition. And I'm very pleased that some of them have committed to take action. I'm not yet seeing the action that I want to see, but we wrote to Peru earlier this year and they've taken action, and 1 or 2 others as well. I'm not pretending it was only us that influenced them, but when you're looking at the governor of the central bank and you say, why are you not a member of NGFS? It puts them literally on the spot. And let's be honest, we lend far more to countries than we invest in companies, which brings us back to the macro stewardship point again. So anyway, that's a little bit tangible and tractable, hopefully more for the average trustee. You know, join UNEP-FI's Net Zero Asset Owner Alliance and listen.
So we're kind of nearing the end, and I'd like to put a final question probably to all of you. And it could be something about what do we hope COP to deliver, all that sort of thing, which we're going to see an awful lot of coverage on in the press, both financial press and mainstream press, and pretty much everything over the next month or so. So I'd like to take a slightly different slant here. We have a question in from Nelson Kasuma, who's saying, as young actuaries with not much influence on how the company operates, what are some actions that we can do to help in influencing the company, where I think the company could be any employer or any client, to commit to sustainable investment? So actual concrete things that people who aren't necessarily in the C-suite, in the boardroom, or even anywhere approaching that, what sort of upward action can we take? Mike, I'm going to ask all of you, by the way. Mike.
Form a group of your peers, have little lunchtime or whatever sessions you have, learn about all the stuff there is. There's a massive amount of stuff outside, and basically a little bit like the pension fund trustees who feel a bit sort of timid, realize you are very influential, and just build the expertise so you can ask challenging questions of all those around you, and you will find you are much more influential than you feared 12 months ago.
Thank you. Steve.
WWF, and I declared an interest earlier, have produced a film called Our Planet Too Big to Fail, which is freely available and is 43 minutes. And as a young actuary, A, watch that, B, encourage everyone you know to watch it, C, ask the board to watch it. And then
it's brilliant.
It really is. And it's got some, Mark Carney speaks and so on and so on. Don't say it, Mike. So we have also got TCFD guidance out there available for all. And the point in producing the guidance was that it should be readable by anybody, absolutely aimed at young actuaries. So please read the guidance, particularly the stuff around scenario planning. Participate in your organization's response to TCFD, because you're probably in one that has to do a response quite soon. Probably, certainly if you're in the UK in a pension scheme or a listed business or an insurance company, we're doing one already. And then maybe befriend a few of your non-execs if you have them, and encourage them to join Cambridge Net Zero. And then you've got a program that encourages your peers, the leaders of the business and the overseers of the business to really start thinking through what they can do at their best to participate in stopping this crisis, because it is the challenge of our generation, and we have only about 7 to 10 years to stop it happening. And it is massive. So everyone needs to do everything they possibly can, as Catherine said earlier.
Catherine, what advice would you have?
Well, I'm completely consistent with what everybody else has just said. I mean, I do think, depending on your role, you must, of course, try to bring climate considerations into your actual day job and into the decisions and work that you're doing. And I don't, you can make that happen. But beyond that, and it may not, there may be limits to how how much the role you're actually undertaking can incorporate climate considerations. There's this whole question of sort of networking within your company, and I've been so impressed by how dynamic some of the sort of internal employee-led sustainability networks are. And for example, we discovered there was a really fantastic one at the Financial Conduct Authority that lots of that there is, which is really good, top-down board level commitment. And I'm really impressed by the leadership at the FCA now around these themes. But I think one of the reasons that's happening is that they're aware that like hundreds of employees at the FCA belong to totally informal employee-led sustainability networks. So those really apply a bit of pressure, and they also help with kind of learning and accessing stuff and just not feeling a bit lonely. And I hope very much that if you grapple with all of that, it'll turn out to be just brilliant for your career as well, and rapidly advance you to the top of your firm from somewhere more lowly. So yeah, good luck with that.
I'd absolutely.
If you've got an MP, once you've got brave, lobby your MP so that they get braver in Parliament. I do that regularly. And also, if you have a parent with a pension, familiarise themselves with the Make My Money Matter and get your parent to lobby their pension provider?
I'd absolutely go along with the thing about forming informal groups within your organisation to sort of get yourselves up to speed, to network, but also be visible within the organisation. And the other thing I would add in is, however junior you are, you can always ask questions of your immediate supervisor. Why are we doing this? Do we need to, should we be thinking about so and so? And if you ask those questions often enough, A, they might get fed up with you, but that's, you know, that happens. But B, they might start to think about the questions themselves. And if they haven't thought about them, just asking those questions just might spark something. And if enough of us do that, it could have it will have an effect. And I think this is partly what we can all do, whatever level in the organization we are, is to continue asking questions. Why are we doing this? If you think it's something wrong, or why aren't we doing whatever it is that we're not doing? So it's now time to draw today's event to a close. And I'd like obviously to thank everyone for attending. Sorry, we couldn't get to all your questions. But I'd especially like to thank Steve, Catherine and Mike for their time and their contributions to our discussion, and of course to our sponsors, our platinum sponsor Milliman and our sponsor Star Actuarial Futures Limited for their support. We've got some great events coming up. One of the ones that you might particularly be interested in is, if you've been to this one, is the one we've got coming up on insurance. So what can insurers do positively rather than simply divesting? But our next event in the series is tomorrow morning, UK time at 11 AM. I'll be joined by Dr. Emily Shutborough, Director of Cambridge Zero at the University of Cambridge, Professor Rebecca Willis, Professor in Practice at Lancaster University, and Marion Elliott, Global Head of Pensions at GFG Alliance, to discuss net zero and the interventions that are required to meet global targets. And you can register for this event and the others in the series through our webpage. Please go and look. I mean, we've got some fantastic events coming up, and they will all be available on Catch Up too. So that's it for today. Please, there will be a QR code just going up for your comments. We're always keen to improve. And again, thank you so much to Mike, Catherine and Steve, who made this an absolutely brilliant and immensely fun discussion to be part of. So thank you very much to all three of you.
Thank you, Louise.